All right. Today is Sunday, March 6th, and this is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight. But we'll keep it short and sweet because I was busy all weekend. It's tough to wash money for the cartel. It's a demanding job. It takes a lot of time, and you might get whacked. So anyways, let's dig in what we have here. We start with the market commentary, and of course, we have more clowns calling that the worst might be already behind us in the stock market. And this is coming once again from JP Morgan's clown, Marko Kalanovic.
What a stupid son of a bitch.
Who continues to say buy the dip, buy the dip, buy the dip since December of last year. And so far it has been catch a falling knife, catch a falling knife, catch a falling knife. And he's not alone, by the way. He got your favorite from Neptune, Tom Lee. And Tom Lee says the stock market is in the eye of the storm of uncertainty, but it already hit bottom and it is poised to turn higher. And I say look at the futures right now. Does it look like we hit bottom yet? I don't think so. And then we have perhaps the most ridiculous call of all time. And this time it comes from the clowns at BCA Research. The headline reads, 1 in 10 chance of nuclear apocalypse, but keep buying share, says investment firm. What are these clowns talking about? Here it is. A financial research company has raised eyebrows by saying there is a 10% chance of civilization being destroyed in a nuclear apocalypse, while urging clients to keep buying shares regardless. BCA Research, a Canadian business, told clients to stay bullish on stocks and largely ignore existential risk, as investments will become irrelevant if the Ukraine crisis leads to nuclear Armageddon. You're gonna lose anyways. So you might as well die rich, right? And of course, they're using some of these sentiment indicators in their favor. In this case, the bull to bear survey ratio. As you can see, we are in extreme bearish territory. The problem is, do yourself a favor and do some homework here. In the past, every time we got to these bearish readings, the Fed stepped in to rescue the market. Now, ask yourself a question. Will the Fed rescue the market again this time around when we have hyperinflation and the Fed is already running out of ammo? It appears that the nuclear crisis will happen in the stock market, not in real life. Or maybe both. Why not? We get a twofer, right? And of course, there are many sentiment indicators and positioning indicators that we can use as contrarian indicators. For example, this is one of them. As you can see, money managers, their equity exposure is pretty much down at the thing crisis back in 2020, which was a very bullish sign to buy stocks. And perhaps this is what Marko Kalanovic and Tom Lee are basing their opinions on this, nuclear, buy the nuclear war thing research firm. But ask yourself a question. What happened last time we got here to the same reading? Well, a crash happened and then the Fed stepped in to rescue the market. The question remains, will the Fed step in once again to rescue the market when we're already on the tightening cycle? Think about that. We don't get down to these readings for no reason. We get here for a reason. And then the question is, will the Fed rescue the market this time around? Or will they step aside watch the fireworks, the crash of the century? Out with the Tom Lees and the Kalanovics of the world. Let's go back to sanity land, because Bank of America says the stock market has more downside coming as investors chase the dip rather than throw in the towel. The stock market has more downside ahead as investors have yet to throw in the towel. They continue to buy the dip over and over and over again. There is no capitulation, regardless of what these sentiment indicators say. Once again, folks, we say, watch what they do, not what they say. They could say in the surveys they're extremely bearish, but their action says otherwise. Their action says they continue to buy stocks. They continue to buy the dip in the wrong stocks. So we have yet to see the extreme capitulation that we saw back in the 2020 crash, back in the 2009 crash. We have yet to see that, at least for now. The bank sees the potential for the S&P 500 to fall to 3,800, representing a 12% downside. Both late January and late February had big gap downs, followed by upside reversals. However, neither showed true capitulation, and this is according to Bank of America. Another bearish indicator is the fact that company executives are refraining from buying their own stocks in 2022, at least so far. Remember, when company executives were selling stocks, this was a sign that the top is around the corner. They have yet to buy stocks. When they start buying stocks, then you know that the bottom is around the corner. Matter of fact, we have Bill Gross, who lives up to his name, by the way. He's a Gross character, but he says he sees possibility of stagflation. Everybody's talking about stagflation right now. This is the sexiest topic among economists right now. Even though your boy, the Maverick Wall Street, the guy you're listening to right now, has been talking about stagflation a year ago. And yet I'm not Harvard, I'm not Yale, I'm not Goldman Sachs, I'm not JP Morgan. I'm just a douchebag on YouTube. Anyways, we continue to monitor what's going on with the Russia-Ukraine crisis, which doesn't seem, at least for now, to cool down at all. But there is a dangerous element in this crisis that we haven't seen before, which is the involvement of private companies in this economic war, sanctioning, whatever you want to call it. Putin came out today and said it is war. It is the equivalent of war. So what is he going to do against these companies who are waging war against his country, according to him? This is one thing we got to think about. We heard from Visa, MasterCard, and these two will be down big tomorrow. This is the assumption. And then you have American Express followed through with the same sanctioning or cutting all ties and business activities in Russia. I'm not sure that this is a sound strategy because you have these private companies shooting themselves in the foot. And yes, the Russian economy and Russia as a source of revenue for these companies is still small, but the market always looks forward. And if these companies are getting involved in this war, this economic war between the East and the West, what will be the reaction of China and other countries across the globe? Because they're thinking, wait a minute here, if we invade Taiwan or if we do something else that the West doesn't like, then we have all of these companies who are going to gang up against us. So the market looks forward and sees risk here against all of these companies. What if they lose China as a source of revenue? And you can understand the panic and the damage that will happen to the stocks of these companies. On top of that, it appears that we have a consensus now to embark an embargo against Russian oil, at least in this country. And if this country does it, by the way, it is just a matter of time before the European Union follows through and takes the same course of action. If that happens, you're already seeing what's going on with the futures right now, as we're speaking right now. Both the WTI and Brent are exploding higher, and this will impact both the US, but specifically the EU, negatively. Big time. We're already seeing what's going on with gas prices in this country, the pain at the pump. The national average for a gallon of gas has now topped $4, the highest since 2008. This is nothing, by the way. You can go to California right now and you see $6+ per gallon. Now, some of our European viewers might look at this and say, what is the big deal? We pay $10, $12, $15 a gallon. We drive more in this country. We have more gas guzzlers. We don't have public transportation in this country. So the pain, the economic pain from $4 to $5 a gallon, if not more, is extremely severe. And if you are experiencing pain at the pump and you're poor, middle class, an average Joe, average Jane, going on to your business, and inflation is killing your budget and your wallet, well, we have Joker Rick Newman who says, "Wanna help Ukraine? ? Stop whining about gas prices. And I'll give it about a month, tops, maximum, of these high gas prices at the pump before the sheep who are now pretending to care about Ukraine in social media to start bitching and whining about gas prices. And at the end of the day, we have an election in November, and the majority of the public will place the blame on the Biden administration. Of course, the Biden administration will use the weaseling tactics, shift the blame tactics, and they will say, hey, this inflation crisis, you have nobody to thank for but Putin. It's not the Fed. It's not that inflation was going higher even before the war. It's not due to the incompetent policies that pushed the prices of energy higher even before the war. Now they got a boogeyman to place all of that blame on. We'll see how that's going to work, by the way. And now Bank of America warns that the Ukraine war raises the risk for a U.S. recession. And by the way, this is not just the sentiment or the call from Bank of America. You have to look at the bond market, and that's all you need to look at. The yield curve is getting closer and closer and closer to inverting. And when that happens, it has been always a reliable sign that a recession is coming. And we're getting closer and closer to that. Now, how can you benefit from all of this insane inflationary environment? Well, look at the top performers of the S&P 500 last week. Number one was Occidental Petroleum, the ticker OXY. This was up 40%. 5% in a week. Unbelievable. And then we have Kroger, necessities. What are you going to do? Not eat? You got to shop. Whether we have inflation, war, nukes, doesn't matter. You got to go to the grocery store. Kroger closed the week with almost 27% gains. And then we have the ticker MOS for Mosaic. This was up almost 21% last week. APA, Apache, that was also 17% in the green. CTRA, all of these oil companies are surging higher. But also, we have the defense contractors, NOC, Northrop, was up over 14%. So again, the choices are becoming limited, but these names are outperforming the market tremendously. It was a Maverick of Wall Street kind of week because my kind of stocks happened to outperform last week. We'll see how this develops, but for now, we want to stick with the same play: oil, gas, agricultural, and the defense contractors, maybe some of the dividend names in big pharma, and of course the consumer staples and the necessities like Walmart and Kroger. Stick with those because it appears, at least for now, these are the only plays we have left in this market. Now let's move right away to charts and do a thorough job here. We start with the S&P 500, the SPY. This is a 30 minutes chart. We talked about the bear flag. Now the bear flag played out and the support of 434, poof, gone. The chart is now hugging the line in the sand at around 430. Looking at the futures right now, it doesn't appear that we're going to keep that support. It looks that the chart's going to go down. We have the next support at around 422. Another way you can look at the chart is this is yet another bear flag formation, and it will play out to the downside again. Here's a daily chart for the continuous contract for the S&P 500. We have a failure in cracking above 4,384.5. The chart tried over and over and over and over again, and it didn't happen. We have a rejection. We have a confirmation of that rejection. Furthermore, look at the volume. It climbed higher on a down day on Friday. Look at the momentum indicators. They're curling down back into negative divergence. All of these are good signs for the bears. The bears will also argue we had a trend line, a steep trend line in the formation. That broke down right away. And we now have another steep trend line, which will be broken right away. And we will see more downside. The chart will take out the bottom in late February. The bulls would argue, not so fast. Yes, we are in a downtrend. We have lower highs and lower lows. But who's to say that the chart is not going to catch support from 4,232, and then we have what it appears to be a reverse head and shoulder? That is still on the table until and unless the support 4,232 is gone. When that happens, the bears would argue that we will make another lower low to continue the pattern. Another way to look at the chart, this is a weekly chart for the same chart we were looking at, the continuous contract for the SPY, the S&P 500. We had a bullish trend. It was intact since the bottom of 2020. This trend has shifted. It is already broken, and we have a bearish trend right now ongoing as we speak. And sooner or later, the chart will go down to revisit that trend line in yellow, as you can see in the chart. Furthermore, you look at the momentum indicators from a weekly perspective, they're all in negative divergence. They're all not done yet in their descent to the southern destination. We have yet to see any sign of bottoming in these momentum indicators from a weekly chart perspective. Here's another way to look at the chart. This is the SPX, the cash index, a daily chart. We are far below the 200 days moving average. And as you can see, we're making lower lows. Sooner or later, we're going to go back to revisit 4,000 and retest that as support. Nobody wants to buy right now. I talk to money managers across the best firms, and they say we're not buying anymore in the case of the S&P 500 until the support of 4,000 holds, because it appears that we're going down that way. Another way to look at the chart. This is again the SPX, but this time around a monthly chart. Look at the MACD indicator. It has been in perhaps the most extended divergence from the mean in history. We'll look at the MACD indicator. Now, we have a crossing in the MACD indicator right now. So far this month, the month is still young, but we have a red impression on the histogram indicating that the bullish trend that lasted for almost 2 years is now over. We will see bearishness. We will see a bear market, aka a crash, because when you're extended that long and that far in the MACD indicator, and then you head down, it will produce a crash. Case in point, here's the SPX back in the dot-com bubble. As you can see, the extension of the MACD goes for a multi-year period. Now, the MACD showed some false signals before, but again, when the ultimate crossing happened and the MACD turned negative for good, this produced a crash of more than 50% in the following years. And again, in 2008, 2009, when the MACD finally crossed, producing the red impressions in the histogram, and we had confirmation for that, the SPX went down and dropped top to bottom by almost 58%. So put two and two together, and all of a sudden it sounds really, really scary. Who wants to buy the dip right now? But hey, Kalanovic and Tom Lee say buy the dip, buy the dip, buy the dip, even though the trend is already dead. They continue to say the trend is your friend. Remember when the morons were leading the markets, the Robin Hoodiots and the likes? And they said, bro, you're too bearish. You're a perma bear. The trend is your friend. Follow the trend till the very end. Well, the trend is over now, and you're still buying the dip. And I told you, you're not going to stop because this is gambling addiction. It happened before. This time, it's not going to be different. The psychology remains the same. Moving on to the Qs, 30 minutes chart once again. It looked good, I have to be honest. The closing was good. It appears to be a double bottom. It closed above 334. When we look at the 30 minutes RSI and MACD, they look that they're bottoming and they're curling their way higher. But again, you look at the futures, and we know we're going to break the 334 support. What do we have left? We have the same point where the chart bounced from the last time around. And if that doesn't work out, then we have 316.46. Either way, we're looking at a lot of pain to come. And perhaps the daily charts explain that better. Here's a daily chart for the continuous contract for the NASDAQ. As you can see, the support line, which will trigger all of the shorting and the bearish activities, is 13,599. You can round that up to 13,600. If the chart closes the day below this number, then you know we're going down to at least either 13,300. The likelihood is it's going to pierce below that. And then we have the trend line in yellow. And if that doesn't work out, then we have 12,766. The volume on Friday spiked higher on the selling side. The momentum indicators are curling down again. All of these are indicators that the bears are pushing back. The bears are zooming in once again. The bears are done with the hibernation and they're coming back to life. One way you can look at the chart is we have a channel. This is a bearish channel, by the way. We cannot break above the resistance, which is the upper range of the channel. So we have to go down to the support line, which is the lower range of the channel. And this happens to be at around 12,766. Now, the bulls would argue, what happened to the ABC pattern? What if we're just forming the B leg? Well, this argument goes down the toilet the moment you close the day below 13,599. Another way we can look at the chart, this is a daily chart for the NDX, the NASDAQ 100. We are way below the 200 days moving average. We're not even close. You don't want to buy a chart when it's trading below the 200 days moving average. This is rule 101 in the stock market. You buy after it crosses the 200 days moving average and you have a confirmation that the 200 days moving average is solid support. Now, you combine that with the negative divergence in the RSI that has been going on since November of last year. We're not out of the woods yet, and all indicators are saying there is more pain to come. Another way we can look at the chart, this is a monthly chart for the NDX. Look at the MACD indicator. It already crossed into negative territory, producing red impressions in the histogram last month. And if we close this way this month, then we have the confirmation that the bullish run in the NASDAQ is over. In my opinion, it's already over. You and I know that. You look at the RSI, negative divergence for the first time since 2019. The last time we saw such crossing in the MACD indicator was back during the dot-com bubble. Once the crossing happened, this was the top. And since then, the NASDAQ went down by more than 83.5%. So there could be a lot of pain ahead. Let's use the Fibonacci levels, and this is the NDX chart, once again, a monthly chart. Let's take it from that bottom, the aftermath of the dot-com bubble. If we do that, then you have to assume that the Fibonacci support that we have right now will not hold, which is around 1,300. And the next support probably will, or at least hold a little better. And this support is down at 10,000. 700 almost, which will be another 23% to the downside from this point on. Now, you can look at it another way. In a shorter term perspective, we use the 2020 March bottom, and when we do that, again, you're not going to trust the support right in front of you, which is around 13,000. You use the next support, and the next support is around 11,800, which is another 15% or so to the downside. What about the IWM, the Russell 2000 30 minutes chart? Again, the closing looked okay, by the way. Friday's closing from a 30 minutes perspective. It did not pierce below 196.5. We have what it appears to be a double bottom for now. The momentum indicators appear to be bottoming, oversold, and ready to cross the positive territory. The problem is the geopolitics, the surge in oil prices overnight, palladium, wheat, etc., is crushing the futures. And if we open down, then say goodbye to the support of 196.5. We're looking down at 191.5. And it gets worse, folks. When we zoom out to a weekly chart for the RUT, the Russell 2000 again, it remains in negative divergence on the RSI. We have what it appears to be a bear flag formation. Now, the hope for the bulls of the Russell is we also have what it appears to be a double bottoming formation. Once you take these lows out, then you know that the bear flag is working out. And if it does, we're going down big time, because let's shift to a monthly chart perspective on the Russell 2000, the RUT. If the bear flag plays out, then you're not going to assume the next Fibonacci support will hold. You take the one after that. And if we do that, we have yet another 14% or so to the downside before we find perhaps a more reliable tradable bottom. What about the Dixie dollar chart? A daily chart. It is on a breakout. Just like oil, just like palladium, just like wheat, the dollar is surging higher because the ruble is getting crushed and we're seeing more demand for the US dollar. For now, the support that we have is 96. The RSI, the MACD, they're all getting overbought. But who's to say that this is going to reverse anytime soon? I see a lot of shorting of oil. I see a lot of shorting of gold, of wheat, of palladium, and playing the opposite move of the US dollar. This is just too mature. I say if you've been playing these plays, oil, palladium, wheat, take some profits on the way higher. Perhaps buy some puts as protection or sell upside calls. But it is too dangerous to bet against all of these breaking out kind of charts because you haven't seen the top yet. And every topping formation that we saw, every topping candle that we saw turned out to be a trap. You're not going to fight these charts because the fundamentals, the news, continue to support them higher. Where can we find resistance in the US dollar's chart? Well, for that, we have to go to a weekly chart. When we do that, look at the resistance of around 99.9, which is about 0.70% to the upside from this point on, at least at the time of the recording of this video. We have multiple reactions before, over and over and over again. The assumption is, technically speaking, we're gonna face resistance at the same point. The problem is you cannot guarantee that. The war remains active. The fundamentals are changing by the day. But from a technical standpoint, you gotta assume the chart will face some resistance at that point. Likewise, here's the chart of gold, the daily chart. It is on a breakout. You're going to continue to buy the dip here. Play the momentum trade, and the momentum trade right now is oil, gold, palladium, wheat, all of the Russia-Ukraine related trades. Until and unless you see a reversal signal, a solid reversal signal. Not just from a technical standpoint, by the way, but it has to be confirmed by the fundamentals, by the news. We have a ceasefire. We have a peace deal. Putin died. Whatever it is. It has to be confirmed by the fundamentals. Otherwise, yes, the RSI is overbought. The technicals are overextended. But who's to say that this chart is not going to blast higher all the way and surge another 4% or so to retag the prior high, the prior top of 2020? Who's to say that this is not going to happen? And here it is, the daily chart, the 10-year yield. It is breaking to the downside. We have negative divergences in both indicators. In all likelihood, if the negativity continues, this chart is going down to 1.55. Think about it. We have the Russia-Ukraine front white hot, active as we speak. We have the Fed saying we're not going to raise interest rates by 50 basis points. We're going to raise rates by 25 basis points. And if the stock market continues to crash, who's to say that the Fed will not intervene and say, hey, too much uncertainty. We're not going to raise rates at all comes the March meeting. It is a possibility. Point number 3. We're dipping into a recession. Sooner or later, it's in the bag. So this chart could go down, take another leg down to revisit the next support at around 1.55. And here is a weekly chart for the TLT. If the 10-year yield is about to go down, then look at where the TLT is trading. It closed the week above 140. This is an important win for the TLT bugs. Number 2, the volume was way above average on the buying side. Number 3, the momentum indicators are curling their way higher, about to break the negative divergence and create positive divergence. Now you might say, hey, there is a relationship between the TLT and the NASDAQ. If the TLT goes higher, the NASDAQ should go higher. Wrong. The TLT goes higher hand in hand with the NASDAQ when inflation expectations go down, and hence the 10-year yield goes down. TLT goes higher along with the NASDAQ. But when the TLT goes higher for the wrong reasons, meaning the rush to safety of buying bonds, the NASDAQ and the entirety of the stock market goes down. So the charts, the pure technicians could look at the charts and get the wrong signal. You got to read the fundamentals. You got to combine the technicals with the fundamentals and the psychology to nail trading the stock market. What about the VIX? This is a 4-hour chart. Look at the MACD indicator. We have a small baby crossing creating green impressions in the histogram. The chart peaked above the triangle pattern of consolidation, peaked above 33, but closed the day or the week below 33. Not a big deal for the bears. We're talking about market bears, of course, because this could be the peak before the eventual break above the triangle pattern and 33. And then the chart recaptures 33 as solid support, which will mean more pain to come, the SPY. Another way we can look at the chart, this is a weekly chart for the VIX. We had a downtrend. As you can see, we have a sloping line of resistance that was broken to the upside. We're now creating a bullish trend once again with the support. As you can see, the smaller trend line in yellow, which is still under construction, by the way. You combine that with the momentum indicators, which are moving higher, accelerating to positive divergence. What does that mean? You put 2 and 2 together and you come up with the conclusion that the VIX is not done popping yet. If the VIX is not done popping yet, the S&P 500 has yet to bottom. Likewise, here's the VXN 4-hour chart, inconclusive for now. We have no signal whatsoever looking at the 4-hour chart, but we'll look at the weekly chart. Once again, similar story with the VIX. We had a downward trend in the VIX with the sloping line of resistance. This trend has been broken, and we're now forming a bullish trend for the VIX with the support line in yellow, which comes hand in hand with a downward trend in the NASDAQ. Now, if this plays out, then in all likelihood, the VXN will take the previous top at around 44, and it's not going to stop until it challenges the previous high from 2020. Yep, watch out here, because the dominoes are falling. Here's a daily chart for Apple. As you can see, it failed to break above the upper range of the channel, which is now back into resistance when it was support. The momentum indicators are failing again. They're curling their way to the downside. The volume spiked higher above average on the selling side on Friday. All of these are bad indicators for Apple, supporting that the chart will go down to revisit the support of 157 before it trades higher. And again, as Apple goes, so will the market. What about Tesla, the souffle? It performed a lot better than the rest of the market on Friday, but there is a problem. We have a negative divergence from an hourly perspective, and the chart has yet to close the gap at around 809.75. You're not going to buy this chart until and unless you see a retest and a closing of that gap successfully. What does that mean? It means closing the gap and then rebounding higher. Or if the chart breaks the pattern of consolidation, meaning it retests the trend line, as you can see in yellow, and it closes the day above that trend line. Absent of that, you're pretty much in no man's land, and the risk is bigger than the reward. And here's the biggest problem with the souffle's chart. We move on to a monthly chart this time around. As we looked in the SPY, the NASDAQ, we're starting to see a negative crossing on the monthly chart. Remember, Tesla is lagging the SPY and the NASDAQ because it will be the last block to fall in this market. I've been saying this for a long time. But if we close the month and we have a negative reading on the MACD indicator, a red impression, then you put 2 and 2 together and you come up with the conclusion that this chart will go down using the Fibonacci levels to at least the 636 levels, which is another 23.5% to the downside. So the risk dwarfs the reward in this chart. What about tulips, BTC, Bitcoin? We have the dreaded triple top this time around, which means sooner or later you're going down to retest 35,750. And if that doesn't work out, We're going down to 30,000. Not buying this at all. Stay on the sidelines. There was a little bit of fundamentals supporting the chart higher, which is perhaps Russians are now buying Bitcoin. But it also could be, or could have been, that we have traders speculating that Russians will buy Bitcoin. And turns out Russians are not buying Bitcoin, and hence the reversal and the turn to the downside. Lastly, in charts, what about AMC? We're still waiting and waiting for the pop to retest 21 as resistance. The problem is, the chart is running out of time, and if it doesn't pop higher on the Batman news, whatever news, to retest 21 this upcoming week, it's going to be over for AMC. We'll take another leg down to breach below 10, because the line in the sand for this chart is at around 14.24. You break that, you're going to flush down to below 10. Lastly, moving on to the conclusion of this video, we have some central banks reporting this week, and this will be important to watch because what if some central banks decide to ease instead of tighten? This will be a bullish indicator that the Fed might do the same, and the market could be rescued this way. Now, on Tuesday, let's play the geography game. We have in Europe, I believe this is Poland, the Polish central bank. And then we have above India, that has to be Pakistan. Wednesday, below Russia, I believe that is Kazakhstan. And then Thursday, we have the country below Kazakhstan, which I cannot name, but I'll take a shot and say it is Azerbaijan. I don't know. No cheating here, folks. Don't cheat. Either you know it or you don't. And then we have a bunch of countries in Europe. Hungary, I can name that, and the country below Hungary, which I cannot name. But I'm going to take a shot and say Bulgaria. And then in South America, we have Peru. I know that because I have a lot of Peruvian friends. And by the way, the inflation problem in Peru is getting out of control. The CPI is over 6% right now. And the expectations are for the Central Bank of Peru to hike rates for the 8th time in a row. And lastly, on Thursday, we have the ECB and another country in South America, which you cannot name, and I'm not going to even try to name because I have absolutely no clue. It's above Brazil. Don't take offense if you happen to be a viewer from that particular country. And lastly, what about the economic calendar for this week? On Monday, we have consumer credit. Tuesday, March 8th, we have the small business index. Wednesday, March 9th, we have the JOLTS. And then Thursday, March 10th, we have the jobless claims, and perhaps most importantly, the CPI, aka the CPLI. We also have the federal budget deficit. And lastly, on Friday, March 11th, we have the University of Michigan Consumer Sentiment Index and the 5-year inflation expectations. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.